Is MGM Resorts stock a potential buy now? In a quarter where he made two short puts against the market, MGM Resorts was one of Michael Burry's biggest buys. Burry's buying into the business, but not for the reasons that you might think. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for MGM. Then we're giving our rating. Before we get into these valuable metrics, let's understand MGM stock performance. Right now, MGM trades for $43.74 per share. Year to date, they're beating the market. Their stock price is up 31.5%, while the S&P 500 is up less than 20%. In the last decade, MGM's compounding at 8% annually. The company took a huge hit in spring of 2020 amid global lockdowns. Since then, it's rebounded, but not quite at the same pace as the S&P 500. MGM had a huge fall during the global financial crisis. Their stock price cratered all the way from $94 in 2007 to just under $3 in March of 2009. Since then, the company is up more than 15 times, but nowhere near their all-time highs. MGM trades $8 below their 52-week high. The company's up $13 from their 52-week low. There's some short interest in the business, with 4% of their shares sold short. MGM's a big company. They have a $15 billion market cap, but they use a lot of debt. They have nearly a $44 billion enterprise value. But the burning question is, why has Michael Burry been buying MGM? MGM Resorts is the largest resort operator on the Las Vegas Strip, with 35,000 guest rooms and suites, representing around 1/4 of all units in the market. The company's Vegas properties include MGM Grand, Mandalay Bay, Park MGM, Luxor, New York, and the Bellagio. The Strip contributes approximately 74% of revenues. MGM also owns U.S. regional assets, which represent 30%. MGM's U.S. sports and iGaming operations are currently a high single-digit percentage of its total revenue. The company also operates the MGM Macau casinos, with a new property that opened on the Cotai Strip in early 2018. It's estimated MGM will open a resort in Japan in 2030. Now let's look at the numbers. Metric number 1, we want their average return on capital in the last 5 years to be above 14%. The average business earns a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Over the long run, over the course of decades, a stock's performance depends on its underlying business. These business returns are captured by return on capital. MGM earned slightly below average returns prior to 2020. Since then, the business was heavily affected by lockdowns. They had negative returns on capital. Although they somewhat rebounded into 2021, the company also has negative returns in 2022. When these are averaged out, MGM has very tiny average returns on capital, coming in just under 1%. This is an X on metric number 1. Metric number 2, we're looking for growth. We want to see 5-year revenue, net income, and free cash flow growth. These all need to be up for this to be a check. Here we really get to see the big hit 2020 had on the business. Their revenues declined by more than half. The company's net incomes, or their earnings, and their free cash flows both went negative. Since then, however, the company has rebounded, and they've actually rebounded pretty strongly. Over this time, their revenues have grown by a total of 30%. Almost tripling in the last 3 years alone, and better than where they were prior to the pandemic. Their earnings have rebounded and they're positive, but they're down around 20% from where they were at in 2018. That doesn't tell the whole picture here, as their free cash flows have increased by more than 5 times. The company generated $1.2 billion of free cash flow in their last 12 months. There's some gray area for MGM, especially as the business has rebounded from 2020. However, because their earnings are down, this is an X on metric number 2, but overall this looked pretty good. Metric number 3, we're looking for earnings per share growth. Here we just learned their net incomes or their earnings are down by 20%, but the company has actually grown their earnings per share. MGM has been a huge buyer back of its shares. In the last 5 years, they've reduced their share count by 30.5%, buying back nearly a third of their entire business. This is likely one of the main reasons Burry's attracted to the business. MGM has really stepped up the pace on buybacks in their last couple of years, buying back a ton of shares in fiscal 2022 and continuing in their last 12 months. These share buybacks outpace their decline in their earnings, meaning they've grown their earnings per share. This is a check on metric number 3. Metric number 4, we're looking for free cash flow per share growth. We see an explosion of MGM's free cash flows per share. Not only have they increased their free cash flows by more than 5 times, This is compounded by their big share buybacks. These two contribute to have huge free cash flow per share growth. Another check here on metric number 4 means through 4 metrics we're split evenly. We have 2 checks and 2 X's. In recessions, it's businesses with a lot of debt that can have the biggest losses or even go bankrupt. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. In this time, MGM has more than doubled their net debt position. The company's been active in deal making. The company sold a lot of its underlying real estate assets, but still managed the operations. In 2021, they bought 50% of Dubai's world share of City Center and sold the underlying assets to private equity firm Blackstone. Right now, MGM has around $28 billion in net debt. When we add up their last 5 fiscal years of free cash flow, they've only produced $1.4 billion worth. That's because their 2020 really works against them. In their last 12 months, they produced $1.2 billion of free cash flow. Still, this is a far cry from where their net debt position is. This is an X. You want to dig in to understand how their debt is structured, whether this debt is still tied to a lot of their properties, if it's potentially non-recourse to the parent business, or if it's more associated with their management operations. It's a bigger question mark for MGM, but it's not necessarily out of the ordinary for these companies focused on a lot of share buybacks, especially ones that are prioritizing free cash flow. Again, these higher debt loads may be some of the reasons behind why MGM is also selling their real estate assets. It's something you'd want to dig in and learn more about. As a bonus metric, we're looking at MGM's dividend profile. MGM pays out a very tiny dividend yield today. They slashed their dividend in response to the pandemic. That was likely a prudent decision as their free cash flows went negative. Even as the company's free cash flows today are positive, again, they're dealing with these higher levels of debt, and they weren't sure how the company would rebound. MGM has a very tiny dividend that's supported by its free cash flows. Even though they cut this dramatically, this is technically a check as their dividend is supported. It's not very meaningful currently for MGM. The big metric of them all, metric number 6, we want MGM's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for MGM. Right now, they have a $44 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at MGM similar to it being a private company. In their last 5 years, we learned they produced $1.4 billion of free cash flow when we added those up, meaning they produce around $280 million in an average year. When that's divided by their $44 billion enterprise value, we get a small 0.6% average free cash flow to enterprise value yield. On a current basis, MGM produced $1.2 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, we get around a 2.7% current free cash flow to enterprise value yield. Both of these are coming in below the yield from the 10-year treasury, meaning they're below our risk premium as well. On metric number 6, this is an X. Don't just throw the business out. Again, part of their enterprise value depends on how their debt is structured. Compared to their current market cap, MGM actually has a very high free cash flow yield, so that's something you'd want to dig in and learn more about. We still need to estimate their fair value per share and talk about our rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze MGM, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with MGM's current free cash flows and using historical assumptions to grow these into the future. Keep in mind, MGM's not been that predictable of a company in their past, especially due to the big hits that they took in both the global financial crisis and the pandemic. It's up to you to figure out if these assumptions will be accurate or not for MGM. This will give us a rougher ballpark estimate than some of our other analyses. Assuming they grow their current free cash flows at just under 11% annually for the next 10 years, then in the following decade, assuming this growth rate is cut in half and these grow at 5% annually, we'll add in their tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, from today's valuation multiples, if these are the same 20 years into the future, an estimate of MGM's fair value per share is around $32.50. That's down about $11 from their current stock price. It's down about $6 from the second quarter of 2023 lows, where Michael Burry was buying into the company. Again, this is a rougher estimate than it would be for other businesses. Most importantly, it's not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our rating for MGM, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for their business. Why don't we figure out what they are? Looking at the factors supporting a long thesis, number 1, it's expected MGM will be awarded with the only urban Japanese gaming concession due to its strong experience operating leading resorts in Las Vegas and its successful record of working with partners. Number 2, MGM is positioned to participate in Macau's long-term growth and has seen its room share expand to 8% from 3% with the opening of its Cotai Casino in February of 2018. Number 3, MGM's U.S. properties are positioned to benefit from the expansion of the multi-billion-dollar domestic sports and iGaming betting market. But it wouldn't be fair if we didn't cover the negatives of their business as well. Looking at the factors supporting a short thesis, number 1, the majority of cash flow for MGM comes from the Las Vegas region, which has lower regulatory barriers, margins, and returns on capital than Macau. Number 2, the Macau government is transitioning the region's mix toward a non-gaming full resort destination site, which could place outsized pressure on growth for MGM, given its relatively low non-gaming mix. Number 3, the Chinese government has full control over labor, table allocations, gaming license, and travel visas. Also, it's increasing its supervision of VIP play, which could result in volatile periods of growth for the region. There you have it for a balanced perspective of some of the qualitative factors for MGM. Now let's give our rating. We learned in analyzing MGM Resorts International, stock ticker MGM, that Michael Burry may be buying into the company due to its strong rebound from lockdowns. MGM's revenues and free cash flows are up massively in the last 3 years alone. In this time, their stock price is also beating the market, and they've really picked up the pace of share buybacks, buying back more than a third of their company with a stock price that was where it was prior to the pandemic with better operating numbers. The company does have quite a bit of leverage, which again, that's something you need to figure out how it's structured. They also have low returns on capital and their earnings are down. That may be more due to the accounting for the business, especially as it's not considering some of their asset sales. Right now, while MGM's free cash flow to enterprise value yields don't look attractive compared to the 10-year treasury, their free cash flow to market cap yield does. Again, this isn't financial advice. When we performed our discounted cash flow analysis from today's valuations, if these are the same 20 years into the future, if you want a 15% rate of return and you believe these assumptions, an estimate for MGM's fair value is around $32.50 per share. MGM last traded at those levels in October of 2022. It's down around $11 from their current stock price. When we look at all the factors of our analysis, MGM looks like a modest candidate for further research. Thanks so much for learning about MGM with me. Subscribe to the channel for more financial videos and check out this next one.